Good morning and welcome to our tax planning webinar. This is where you're going to learn last-minute tax saving tips. And we're going to try to keep this within about 30 to 45 minutes. And if you have any questions, there's a little question tab that you can ask the question. We'll get to as many as we can at the end. And I am Alan Clopine, CPA. I'm co-CEO and Chief Financial Officer of Pure Financial Advisors. And I'm joined by Brett Greenig, CPA. He's a tax planner at Pure Financial Advisors. And we are with Pure Financial Advisors. We're fee-only financial planners, meaning we only accept fees from clients. There's no commissions, there's no backroom deals, there's no kickbacks. It's very clean. All of our advisors are certified financial planners because we believe that if we're going to be giving you advice, our advisors need to be well qualified. We have about 50 employees. Our headquarters is in San Diego, but we also have offices in Irvine and Woodland Hills. So why in the heck do we do this class? Well, I would tell you as a CPA for, I don't know, over 30 years, there's a lot of misinformation out there on our tax code. And as you guys know, it's very, very complicated. And because of that, we want to educate you as to some of the techniques that are available out there. Now, let's maybe a little history. 1913 was when income taxes were ratified with the 16th Amendment. The Congress said that they shall have the power to lay and collect taxes on income from whatever source derived without appointment among several states and without regard to any census or enumeration. So this means they can tax us without our consent or approval. It wasn't such a big deal back then because most people paid 1% tax rate, but the maximum rate was 7%. But look what, 5 years later, 1918, the top tax rate was increased to 77%. That's not 17, that's 77%. And then if you look at what's happened to taxes over time, by 1930 the rates came down, which was good. The highest rate was 25%. But look at 1952. The rate was 92%, which means if you're in that highest tax bracket, you got to keep 8% of your income. The government got 92%. Now, in recent history, 2012, we had the Bush tax cuts. The highest rate was 35%. 2015 and 2016, the highest rate's 39.6%. What will it be going forward? Well, it's hard to say, but ask yourself, do you think tax rates are going up, down, staying the same? Here's what I look at, the U.S. national debt as of March 28, 2016, $19 trillion. How do you think we're going to get that paid off? And what about Social Security? It needs help. What about Medicare is in a bit of trouble? And did you know that 10,000 baby boomers are retiring each and every day for the next 14 years, and a lot of them are underprepared? So it seems to me the tax rates are more likely going up. And so we're going to talk to you about how to stay out of potentially higher tax brackets in the future. So today, here's our agenda. Let's start with tax changes for 2016 to help you out on your tax return and tax filing. We'll get into how healthcare laws might affect your taxes. Tax smart asset location, which basically means by putting certain investments in certain kinds of accounts, you're going to get to keep more of what's yours. That's a really important concept. Roth conversion opportunities. In 2010, they took away some of the limitations on who could convert Roths, and it's still available in 2016. This is probably one of the best strategies available out there. We'll spend a little time on that. And for those of you that are charitable, we'll dive into that, ways to get more from your charitable deductions. And finally, kind of putting it all together, distributions, ways to keep more of what's yours. And that's really what this is all about. You make a good income. If you're retired, maybe you have a pension, maybe you have Social Security, maybe you have money out of your IRA. How do you keep more of it and pay less in taxes? So with that, let's start with the tax changes for 2016. And I'm going to turn it over to my friend and partner, Brett Greenig.
All right. Yeah, let's take a look at some key limits for 2016 to get us started here. All right. So as Al mentioned earlier, our highest federal marginal tax bracket is 39.6%. And for 2016, this is the tax rate for any taxable income over about $415,000 for single filers and around $467,000 for couples filing jointly. There are also new AGI levels for 2016 where itemized deductions and personal exemptions begin to be limited. For single filers with AGI above about 259,000 and joint filers with AGI around 311,000, deductions and exemptions may be partially or fully phased out. And lastly, in regards to personal exemptions, the amount you can claim for yourself and your dependents went up from $4,000 last year to $4,050 this year.
Yeah, we should mention that AGI, that stands for Adjusted Gross Income, and where you find that figure is on the front page of your 1040 at the very bottom. And that's kind of an important number because a lot of things, as we see here, start getting phased out at certain income levels.
Right. Yes, and if you are someone who is in those higher tax brackets, the best way to mitigate your tax liability is contributing to IRAs and qualified retirement plans. Essentially what you're doing is shifting taxable assets to tax-deferred accounts. Of course, this is a strategy for those people who are still working, but nonetheless, the current tax benefit can be quite significant. All right, let's take a look at retirement plan deferrals for a moment. 401k limits remained unchanged for 2016. And even though 401ks are the most common, keep in mind we're talking about other defined contribution plans as well, like 403bs, 457s, and even federal thrift savings plans. You can still contribute 100% of your earnings up to $18,000, and if you're age 50 or older, you can defer an additional $6,000 as a catch-up contribution.
And I would tell you this is probably the best place to start retirement savings because many employers have a match, meaning that you put some money in and they'll put some money in, so you get some free money. So this is something that if you have an employer that has a match, make sure you at least contribute to maximize that match.
All right, next we got IRA limits. Those remained unchanged as well for 2016. You can still contribute up to $5,500 to a traditional IRA or a Roth IRA, or any combination of the two. For those of you who are age 50 and over, a catch-up contribution is allowed here as well, and that is up to $1,000. Okay, IRA income limits. Those remained unchanged as well for 2016. Now let's talk about this for a minute. When we're talking about income limits for IRA contributions, we are only talking about the deductibility of those contributions. Regardless of income, you can always make a contribution to a traditional IRA. To know if all or some of the deduction you have is deductible, you have to ask yourself, am I a participant in a employer-sponsored retirement plan? If so, the deductible portion of your contribution is going to be phased out for single filers with an AGI between 61 and 71,000, and for joint filers with AGIs between $98,000 and $118,000. So what this means is if your AGI is less than 61,000, you can deduct the full contribution. If it is 71,000 or more, you can't deduct any of it. For instance, so what happens here is if you fall somewhere in the middle, then your deductible amount gets prorated. So let's say that your AGI turned out to be 66,000 and you're a single filer, you could deduct exactly half of it.
If you didn't get to deduct all of your IRA, make sure that you fill out Form 8606 because that's what tracks your income tax basis in IRAs. And so therefore, when you pull money out of the IRAs in retirement, you don't have to pay tax on all of those dollars.
All right, next we've got Roth IRA income limits. Those were actually increased a little bit in 2016, about $1,000 from last year. Now the phase-out range for single and head of household filers is $117,000 to $132,000, and for joint filers it's $184,000 to $194,000. Just like the IRA contributions, if your AGI falls inside the range, the contribution allowed would be a prorated amount. The second bullet point here is very important to keep in mind as well. These income limits apply to contributions only, not conversions, which Al will talk about in a few minutes. Okay, the next slide, the new IRA rollover limit. This is a very important concept to understand. Under interpretations of the old rollover rules, 60-day rollovers from IRA to IRA were limited by one per account. In other words, if you had several IRA accounts, you could do as many rollovers as you like as long as the same dollars were not moved again in the same year. Under the new rule, the limit is now one 60-day rollover per taxpayer every 12 months or 365 days.
Yeah, and this has to do, if you have an IRA, you can take money out, use it for any purpose, as long as you put it back in the IRA within 60 days, you're not taxed. Now the IRS is telling us you can only do one per year regardless of how many accounts you have.
All right, so what would the tax consequences be if you violate this rule? Well, basically the second rollover will be deemed an invalid rollover. And that means that it must come back out of the receiving IRA as a removal of excess. The removal of excess distribution will be subject to the 10% penalty, if applicable, plus of course any taxes due. Any invalid rollovers not removed will be treated as excess contributions for that year and will be taxed at 6% per year until removed.
So Brett, you're saying if you've got more than one rollover by mistake, right? You put it back into the IRA. First of all, that's a disallowed transaction. You got to pay tax on that money in the IRA plus a 10% penalty if you're under 59.5, plus another 6% per year excise tax for keeping it in the IRA. So it's something that you don't want to do. You want to be careful of this one.
Yeah, that's exactly right. It can end up costing you a lot. All right. Another important thing to remember here is that this rule applies to distributions from IRA to IRA. If you process trustee-to-trustee transfers between IRAs, there is no reporting, and these transactions are unlimited. Also, if you distribute assets from qualified retirement plans, like a 401k, and have it directly sent to your IRA, these transactions are unlimited as well. Lastly, Roth conversions are also unlimited. Okay, let's talk a little bit about the 2015 budget bill and the changes that were caused by that. In December, Congress passed an enormous budget bill that made many temporary tax breaks known as tax extenders permanent. Here are a few that may affect your tax situation. Number one, the American Opportunity Tax Credit, otherwise known as the college tuition credit, was made permanent, providing credits of up to $2,500 per year, subject to income limits, of course, for qualified educational expenses. If you're funding your child's college education or maybe your own education, this could be a great credit to take advantage of. Part of the credit is non-refundable and part of it is actually refundable, so it can actually be quite valuable. Unfortunately, it does get phased out, and for single filers, AGIs between $80,000 and $90,000 is where you'll see that phase out, and for joint filers, their AGI between $160,000 and $180,000. All right, number two, the Residential Energy Efficient Property Credit, otherwise known as the Solar Power Credit, was extended through 2021, providing a credit of up to 30% of qualifying solar power and water heating equipment costs. If you're planning on adding a solar power system to your home, keep this credit in mind, as it could actually be quite significant. This is a non-refundable credit, but may be carried forward if for some reason it's not fully used.
And by the way, this works for heating your home and the water heater in your home, but not your pool. They don't let you use this for your pool.
All right. Number three, the ability to process direct tax-free transfers of IRA assets to charitable organizations is now allowed permanently. You must be over 70.5 to do this, however, and gifts up to $100,000 per person can be done and may even include your required minimum distribution. You might be saying, well, I could always take a distribution and then give it to charity and include it as an itemized deduction. That is true, but the beauty of this transaction is that it is never included in your AGI. And with so many deductions and credits sensitive to AGI, this benefit could be substantial.
Yeah, and here's a big one is if you can keep your required distribution off the front page of your 1040, then maybe less of your Social Security income is taxable because there's a sliding scale there.
That's a good point too. All right. Number four, let's talk about a few business changes. If you own a business, you could actually find a couple of huge tax breaks here. First off, the Section 179 depreciation write-off was brought back to $500,000 per year. Before this bill was passed, the limit most recently was $25,000 per year. This provision allows you to depreciate purchased assets, new or used, up to $500,000 in 1 year. Also, if your company qualifies, the research and development credit was made permanent as well. Lastly, as far as depreciation goes, a temporary extension was granted until 2021 for the bonus depreciation. This is another tax break that can be used in conjunction with the Section 179 depreciation, but only applies to brand new assets and not pre-owned ones. So keep that in mind. The bonus depreciation allows for 50% of the remaining cost basis to be depreciated as well after the Section 179 depreciation is used up. All right, let's look at the gift tax and estate tax issue. The federal gift tax and estate tax exemptions went up by $20,000 to $5.45 million in 2016. Both exemptions are reduced during your lifetime by any gifts that exceed $14,000 per year per person. The annual gift exclusion, which is the first $14,000, is totally tax-free and in fact not even reported. When an estate is transferring out more than deceased person's remaining lifetime exemption, the maximum tax rate the estate could be subject to is 40%. That means if the assets are valued at $1 million over that exemption, the tax would be $400,000. If you're one that feels your estate may eventually be subject to these kinds of taxes, estate planning is going to be essential. If planned for properly, a large portion of these taxes may be avoided.
Yeah, this is a big one because if you think about it, so the first $5,450,000 of assets, if you pass away, go to your kids tax-free. And if you're married, you get to double up on that. So it's almost $11 million goes to the kids tax-free. But if you are over that, anything over that is that 40% tax. If you're $10 million over that, it's a $4 million tax. So if that applies to you, there's a lot of advanced estate planning techniques that you can take advantage of, but you got to do them now before you pass.
All right, now let's take a look at how healthcare laws may affect your taxes. Obamacare and your taxes. The Patient Protection and Affordable Care Act, also known as Obamacare, might affect your taxes in 2016 and for years to come, actually. The biggest change is the requirement to have health insurance that meets federal guidelines. Chances are that if you're covered by an employer-sponsored plan or even Medicare, you're probably okay and won't be affected. However, the penalty for not having health insurance went up dramatically in 2016 to 2.5% of household income, or $695 per adult, whichever is greater. The family maximum penalty for 2016 is $2,085, which is 3 times that per adult amount. And in 2017, the household amount will remain at 2.5%, but the per adult fee will go up with inflation. Okay, the new healthcare tax forms. The Affordable Care Act also introduced new tax forms. Some taxpayers will need these to complete their taxes for 2015 and beyond. These forms are associated with the type of and source of health insurance coverage you had for the year. Depending on the type of form you receive, it will show you type of coverage you had, any tax credits you received, any dependents on your policy, and the period of coverage. So just be on the lookout for these forms if they're relevant to you and if you haven't seen them yet.
Yeah, and there's a couple things that they're trying to get at. One is if you don't have health insurance, there's a form to calculate the penalty. And another one is if you do have health insurance and your income is low, you may have a credit available for you.
Okay, along with these new forms that we just talked about, the penalties for non-compliance, here are a couple of new taxes that came onto the books in 2013 that specifically targeted high-income taxpayers. So the first was a supplemental charge to Medicare wages. So who does this affect? Single tax filers with earned income above $200,000 and married couples filing jointly with earned income above $250,000. This includes all wages, compensation, and self-employment income earned during the year. The first $200,000 is taxed at the normal 1.45%, and then all additional earned income above that is subject to another 0.9% tax for a total of 2.35%. The second new tax was the Medicare investment tax, which affected investment income. So what is investment income? Well, basically it includes your interest, your dividends, any capital gains, rents and royalties, annuity income, and any income from business considered a passive activity. Luckily, distributions from retirement accounts and Social Security benefits are not included in here, but these are all incomes that you need to be aware of for this tax. And the way it works is it's an additional 3.8% tax that's applied to investment income over the same thresholds as we just discussed. The tax calculation is somewhat complex, but explained in a simple way, the tax is determined by multiplying 3.8% by the lesser of either your net investment income for the year or your income above your threshold. And also, just as a by the way fact, these thresholds amounts haven't been indexed for inflation and thus haven't changed since 2013. Okay, medical expense deductions. Before the Affordable Care Act, if you itemized your deductions, you could deduct medical and dental expenses incurred for you, your spouse, and your dependents as long as those expenses exceeded 7.5% of your AGI. Now that threshold has been raised to 10% of AGI. However, if either you or your spouse is age 65 or older by the end of the calendar year, you can still take advantage of the old 7.5% floor for 2015 and 2016. For 2017 and beyond, everyone regardless of age gets the 10% AGI threshold. You may be wondering what kind of expenses you can deduct here. Well, basically, it's any cost associated with diagnosing, treating, or preventing a disease which will qualify. These include prescription drugs, some insurance premiums, medical equipment, and even travel costs sometimes to those appointments. Now, keep in mind you can never deduct costs that were later reimbursed. All right, I'm going to shift back over to Al, and he's going to talk about asset allocation and the importance there.
All right, thanks, Brett. Marvelous job, by the way. So we are going to get into some planning techniques. I like to use the cursor, so try not to get too dizzy from my cursor skills here. So the first thing is asset location, tax-smart asset location. So let's kind of set that up by saying that we would recommend when you have an investment portfolio, particularly when you're in retirement, probably 12 to 16 different asset classes. And an asset class might be a large company stocks like the S&P 500. It might be small company stocks. It might be international stocks, value, growth. It could be emerging markets. And then you got to have a lot of safety. It could be T-bills. It could be treasury inflated protected securities. It could be short-term bonds, a year, 5-year bond type thing. You probably should have each of these in your portfolio. But where you put these assets is going to make a big difference in your taxation. So let's take a look at tax diversification, because that's a concept that not a lot of people understand. It's just as important as asset diversification. There's a tax-free pool. That's going to be a Roth IRA, could be municipal bonds. When you take money out of that pool, there's no tax to pay. Tax deferred, well, that's going to be your IRAs, your 401ks, your 403bs. You pull money out of there, it's taxed at the highest of rates, that ordinary rate. And then taxable, well, that's non-retirement type of accounts. We call those non-qualified accounts. That could be stocks and bonds, mutual funds, could be real estate. If you hold an asset for at least a year and sell it, you get a special long-term capital gain rate, which, by the way, is 15% for most people. Some people pay 20%. Some people actually pay nothing. So we're going to get into how to do that. So when you think about where to put your assets, you're going to have some safe assets and you're going to have some more aggressive assets. So right off the bat, why don't we look at the least tax efficient, and that's where you want your lowest return assets. That would be your tax deferred accounts, IRAs, 401ks, 403bs. Here you want maybe some fixed income type items. Fixed income generally produces interest income, which is ordinary income. If you put those in your taxable accounts, you're just adding to your higher tax rate because it's ordinary income. So you're trying to match that ordinary income with that tax pool. Plus, you don't want your highest growth in the tax deferred because it will just increase your taxes later. Now, if you look at the taxable, so that's middle. So you want to put assets that grow a little bit there because you got that special capital gains rate, which I mentioned is 15% for most people. And then tax-free, well, that's going to be where you want to put your highest earning assets in your Roth IRA. And so now you got to figure out, well, what are my assets that have the highest expected return? Well, generally they're more volatile, but they also over the long term have higher rates of return. For example, based upon history, small companies outperform large companies, and value companies, cheaper companies, outperform growth companies, expensive companies. So that's something you ought to know. Also, when you're looking at international companies, emerging market companies that are in emerging market countries like Brazil, China, India, those perform better than established countries like Britain, France, and so forth, Germany. And of course, yes, they're more volatile, but you have higher rate of return. And where do you want to put your highest rate of return assets? Well, you want to put that in the Roth IRA because you get to keep more of that asset. Now, there's another thing that you need to be aware of, and that's with your non-retirement assets. It's called tax loss harvesting. So we all know that the stock market goes up, it goes down. Fortunately, it trends up for the long term, but it can be a bit of a rocky road. In fact, in early 2016, it went down about 10%. So what a lot of people did at that time is they did nothing, and they were upset with their stocks. Of course, what happened by the end of the quarter was it recovered and then some, which was great. But here's what I want you to do instead. I want you to actually look at those positions that you own, and if there's a potential loss, go ahead and sell that position. Create a loss that shows up on your tax return. Now, here's the key. I don't want you to go into cash. I want you to invest in something similar so that you're still in the market. For example, let's say you had the S&P 500 fund and it went down. You sell that fund, you buy the Wilshire 2000 fund, something similar. It can't be the exact same fund, but something similar so that when the market goes back up, you will receive that market recovery. But in the meantime, you've created a loss that shows up on your tax return. And guess what? You get to take $3,000 per year against ordinary income, which means salaries, interest, dividends, pensions, Social Security. But better yet, you can use those losses dollar for dollar against capital gain income, any other gains. So let's just say you had done this in January and you got a $50,000 loss on your tax return, and you go through the whole rest of the year without any kind of gain at all. So that means, all right, no gains to net against it. You got a $50,000 loss. You get to use $3,000 of that into 2017. And so 2017, you got a $47,000 carryover. And let's say you sold a stock at a gain, or mutual fund, index fund at a gain of $40,000. So that $40,000 nets against that $47,000 carryover dollar for dollar. You pay no tax on that. Plus, you get another $3,000 against ordinary income. This is one of the best tools out there, particularly for those of you that are in retirement, to keep out of higher brackets because you can net those losses against future gains. And by the way, when you're in the lowest two brackets, the 10% bracket and 15% bracket, your capital gains are taxed at zero. And those levels are about $75,000 of taxable income for a married couple and about $37,000 for a single person. So putting your assets in the right place is a big deal. How about this? Roth conversion opportunities. It's still available in 2016. We're going to go back to the same thing. Taxable, tax-free, tax-deferred. All right, tax-free. This is kind of the holy grail. This is where you'd like to get more of your assets because everything that comes out of here is tax-free. There's a couple ways to put money in here. One is a contribution. You take money out of these taxable accounts and you put them up here in the tax-free. As we saw earlier, you're allowed to put in $5,500 per year or $6,500 if you're 50 and older. And but there is some limitations. You have to be working. You have to have earned income or self-employment income. And if you make too much, you're limited as to what you can do. Now, if your spouse is working, you can use your spouse's income, and this is important for a lot of you. Now, the other one, the bigger one, is tax deferred. You're allowed to take the dollars out of here, your IRA 401k, and put it up into a Roth. That's called a Roth conversion. And guess what? There's no limits there. Anybody can convert at any age. You can be 25, you can be 90 and do a conversion. You don't have to be working. It doesn't matter what income level, and you can do any amount of conversion that you want. So as a little review, that Roth conversion, $5,500 a year or $6,500 if you're over 50, but there are restrictions based upon income. The conversion, that's the bigger one. There's no income restrictions at all. And here's another thing is you can recharacterize if you want to. So what does that mean? If you take a look at this, you've done your conversion. let's say you did a $50,000 conversion, and by the time you do your tax return next year, you realize, whoops, that was too much. That put me into too high of a tax bracket. I'm allowed to take all or part of that $50,000 and put it back into the IRA as if it never happened. This is one of the best tax strategies out there. So few people know it. You can do your conversion, and if you need to recharacterize some or all of it, you're allowed to all the way to the tax filing date of next year, which is April 15th, or if you extend, it's October 15th, and now we're talking about 2017. So if you think about this, what is the optimal Roth conversion strategy? Well, first of all is convert while you're in lower tax brackets. That's a little bit obvious, but what if you're in a higher tax bracket? Are you out of luck? No, not at all. In fact, we have lots of clients where we can introduce other tax deductions to get them into lower tax brackets so that they can convert in lower brackets. And for some of you, you're subject to alternative minimum tax, which is a very high tax rate. There's actually this weird zone in the tax code where we call it the AMT trough or the AMT sweet spot. At certain income levels, even though you're making a lot of money, you're actually temporarily in a lower bracket, so you want to be looking at that. Realize that multi-year Roth conversion strategies are available. It's not all or nothing. So in other words, if you have $1 million in your IRA, you can convert $1, $10,000, $100,000, $1 million, anything you want. Now, a lot of folks, when they hear us talking about Roths, they get very excited. They want to convert as much as they can or even everything, and we will tell you not to do that. If you have $1 million, do not convert it all at once because you'll be in the highest tax bracket. So have a sensible strategy, kind of a multi-year strategy. Use recharacterizations to your advantage. Convert now, even though you don't know exactly what your income is going to be in 2016, because you can recharacterize whatever you want to later on, and that's until October of the following year. And here's kind of a more advanced topic. This is really a pretty good thing here, which is consider a double conversion. So what the heck does that mean? You can convert as many amounts and accounts as you want to. So let's say you do a tax projection and you decide that $50,000 is the right conversion for me to keep me in a lower tax bracket. Well, I would suggest that why don't you convert 2 Roth IRAs of $50,000 each. So now you got 2 Roths going. Let's invest one maybe in stocks, higher expected return, and one in fixed income. Safety, right? And now we go all the way till October of next year and see which one performs better. That's the one we keep. We put the other one back that we don't want. It is such a great strategy, and those that have been doing this since 2010 have ended up with a lot more money in their accounts. So as a summary, Roth conversions, they have to be completed by December 31st. It's not on April 15th. That they have to be completed in the current tax year. And you can recharacterize by October 15th of the following year. That's the extended due date. So please take a look at those because a lot of folks are going to end up in a much better situation by doing Roth conversions. So why don't we skip over now to charitable gifting strategies, to give or not to give. Well, I guess let's first talk about the types of charitable gifts. So there's cash contributions, non-cash contributions, and appreciated assets. Because a lot of people, they write a check or they give cash and they think that's the only way to give to charity, and that's not true. You can actually go through your garage, give away old stuff to Goodwill, Salvation Army, and the value of that contribution or of that item is a deductible contribution on your tax return. The IRS says that you can do $500 of non-cash contributions without having to itemize, and if it's more than $500, you do have to itemize what you gave away, but they don't want an exhaustive list. They want something like 6 bags of clothes. That's good enough for the documentation part. And then appreciated assets. Boy, this is probably the best one yet, right? Which is you've got a stock. Maybe you bought Google and you paid $1,000 for it, and now it's $20,000, right? So if you sell it, you've got a $19,000 long-term capital gain. Well, if you want to give $10,000, $20,000 to charity, why not give the stock instead of cash? Because when you give $20,000 of Google stock, you get to write off as a charitable contribution what that stock is worth, and you avoid that capital gain. It's really a great way to give, and almost all charities will accept stocks. And guess what? When they get the stock and they sell it, they don't pay any tax because they're a nonprofit. So here's another one which you may not know about. It's called a donor advised fund. This is actually deducting future year charitable contributions in the current year by establishing this account. It's a pretty nifty tool that you can go to TD Ameritrade or Fidelity or Schwab. They all have them. You set up a special account, you put money into the account, you're in charge of it, you decide how it's invested, and the year that you put the money into this fund is the year you get a tax deduction. It's not the year when charity gets it. So you kind of have your own little account that you can dole out to charity over your lifetime, or even if you pass, your kids can take over and dole it out for you. So if you find yourself in a very high tax bracket and you're charitably inclined anyway, this would be a good year to go ahead and take that deduction for future year contributions in a year where it makes the most sense for you. So why don't we kind of put this all together, distributions, ways to keep what's yours. How do you kind of set this up so that you can pay the least amount of tax all throughout your retirement life? Well, I would say this. You kind of start with your income plan. And an income plan, you first have to look at what are your sources of income. Maybe you got the 401k or 403b. Maybe you have a pension, maybe not. You probably have Social Security. Hopefully you've got some trust assets. These are assets outside of retirement. And hopefully as a result of this webinar, you've got a Roth IRA. So take a look at your income sources and then let's figure out how they're taxed, right? So we look at the top ones, 401k, 403b, 457, pension, Social Security. These are all taxed at ordinary income rates. Those are the highest of rates. That's what we kind of want to minimize if we can. Excuse me, trust assets. If you invest those for long-term growth, that will be capital gain rate. And a Roth IRA is 100% tax-free. Now the truth is, part of Social Security can be tax-free if your income is low enough. If you've done some of this planning, maybe you'll pay less tax in Social Security. Even if you're in the highest income tax bracket, 15% of Social Security is tax-free to the federal return. And guess what? None of it's taxable in the state of California. So that's a pretty good income source that's somewhat tax efficient. Trust assets, those can be tax-free as well if you've done tax loss harvesting or if you're in the lowest of brackets. And of course, Roth IRAs are always tax-free. So, all right, so now we know how they're taxed. What about this? We got to develop a distribution plan to minimize taxes. So how in the heck do we do that? Well, we're going to actually have to go to the tax tables to figure this out. So here's 2016 married filing jointly. If you're single, it's a similar type table. The numbers are just a little bit different, but you'll get the concept. So this is the tax brackets that we have right now. It's a graduated tax system. So, and this is taxable income. This is line 43 of your tax return, not adjusted gross income. This is what you're actually taxed on. So between 0 and 18,550, you're taxed at 10%. From 18,551 to about 75,000, you're taxed at 15%. Once you get to 75,301, you're taxed at 25%. So I'll ask you this question. If your income is 75,301, is all of your income taxed at 25% or is it just the $1? Unfortunately, the answer is it's just the $1. So no matter what your income level is, you still pay some tax at 10%, some at 15%, and so on. So let's just say, to give you an example, let's say that you're living on $100,000 and you're trying to stay in the 15% tax bracket. Well, that's difficult, right? Because 75,000 to 151,000 is a 25% tax bracket. And I'm just going to say without regard to deductions and exemptions, I just want to keep this simple. So you need $100,000 and 25,000 of that will be taxed at 25%. So here's a little smarter way to do this. How about maybe the first $75,000 of income comes from pension, Social Security, maybe your 401k, maybe your IRA, maybe your 403b if you have it. So that's going to be taxed at 10% and 15%. But you're saying, but I need $100,000 of income. Where do I get the other money from? And the answer is that last $25,000 you'll get from the Roth IRA, which is tax-free. Or maybe you'll get it from your non-qualified account because you've done some tax loss harvesting. And I will tell you what, you may be living at a $100,000 income level like your neighbor, who is paying 25% tax, but you're only paying 15% tax because you have tax diversification and you're being smart about what you're pulling from what accounts. So going back here just to take a peek, developing that income distribution plan to minimize taxes has all to do with what your income sources are, how much income you need, how it's taxed, and then putting that all together. It's one of these things that so few people pay attention to, and if you pay attention to putting your assets in the right place, doing Roth conversions, and having a good income distribution plan, you will pay a lot less in taxes. And we've run projections for folks, and in some cases people are paying hundreds of thousands of dollars less in tax over their lifetime, and even in the millions of dollars is pretty significant. So, all right, we went over a lot of stuff, and so now what? Well, I would say this, that we're Pure Financial Advisors. Help is available. If you have a question, you can email us at info@purefinancial.com. Also, you can go to our website. It's all full of all kinds of information. We have probably 200 different videos on our website, purefinancial.com, that will talk about this topic and other topics. And as part of that website, in the top right-hand corner, you can push a little button that says free assessment. We'll actually give you 2 meetings of free to go over these strategies and others as to what's going to work out and apply for you. So I guess with that, we're going to answer some of your questions, and looking at the time, it looks like we have time for maybe a couple questions here. So I'm going to start with Mary, and she asks, if you're moving money from an IRA to a Roth IRA, does the tax have to come from the IRA investments? Answer is no. And she's got a second question. Can the tax come from an RMD and not the IRA? Well, let's talk about this. When you have and when you're converting money from an IRA to a Roth IRA, you do not want to pay the taxes out of your IRA, because if you think about it, that's additional income. You'd rather pay the taxes out of money that's outside of a retirement account, so you're keeping that tax to a minimum. So the answer is no. You not only do you not have to, you don't want to have the tax paid out of your IRA. Secondly, can it come from your RMD? It can. So here's what happens is you have to take your required distribution before you do a Roth conversion. But once you take your required distribution, you've got that money, and you can use that money to pay the tax. Now here's the next question. This is from Bonnie. And she asks, can you discuss how a TOD, transfer on death deed, would affect tax planning, and if it is possible to use that designation on title for property in a revocable living trust? That's an interesting question. Let me explain. Transfer on death titling is something that you can do for your non-qualified assets, your non-retirement assets, and it's what happens is when you pass away, they go directly to who you've designated on your transfer on death form. It's kind of like a beneficiary statement for an IRA 401k. So that is a way to go. Now, when you have a living trust, revocable living trust, what happens is that your assets, all your non-retirement assets, should be actually titled in that trust, and the trust itself takes over for that. So you don't really, there's no reason to have transfer on death inside of a living trust. In fact, a trust document is even better, because now you can designate all kinds of different people or stipulations on who gets this money, where a transfer on death is just simply a transfer on death. So once you have the living trust, there's really no need for this transfer on death titling. Good question, though. So at any rate, with that, I hope you enjoyed it, and I think we stayed within about our 45 minutes, or just about. And again, if you'd like any more information, you can go to purefinancial.com. Thanks, everybody.